Hey everyone, welcome back to the channel. If you're on the hunt for an undervalued stock with solid growth potential, then you're in for a treat today. We're diving into one of my top picks for long-term dividend growth. We'll break down the math behind why this stock might be undervalued using the discounted dividend model, or DDM. By the end of this video, you'll not only know what stock I'm talking about, but you'll also see how it stacks up based on valuation techniques. Let's get started. Before we reveal the stock, let's quickly talk about why dividend-paying companies are attractive to investors, especially when they're undervalued. Dividends offer a reliable stream of income, and if you choose the right stock, you can benefit from long-term growth as well. In today's market, finding an undervalued dividend stock can set you up for both income and capital appreciation. And now, let's jump into the valuation method we're using to identify whether this stock is truly undervalued. Introducing the discounted dividend model. The discounted dividend model, or DDM, is a powerful tool that helps you calculate the fair value of a stock based on its future dividend payments. This is especially useful for companies that pay consistent dividends. Here's the basic formula we'll be working with. Stock value equals D1 over R minus G, where D1 is next year's expected dividend, R is the required rate of return, and G is the dividend growth rate. The model assumes that dividends will grow at a constant rate, so it works well for companies that have stable dividend histories. But when a company is growing fast, we need a more flexible version of this model, which I'll explain shortly. Before we break it down, please like and subscribe to the channel. It helps motivate me to create more content like this. Now that we've laid the foundation, it's time to reveal the stock we're evaluating today. NextEra Energy, NEE. NextEra is a leading renewable energy and utility company with a strong history of paying dividends. We'll apply the discounted dividend model to see if it's undervalued right now. Here's what we need. Next year's expected dividend, D1. In 2024, NextEra is expected to pay $2.14 per share. Required rate of return, R. For utilities, we'll use a 7% required return, which is typical for stable industries like this. Dividend growth rate, G. NextEra has been growing its dividend at a rate of about 9% annually. If we use the basic DDM formula, stock value equals 2.14 divided by 0.07 minus 0.09. This formula doesn't work when the dividend growth rate exceeds the required rate of return, so we need to adjust the model to account for higher initial growth. This brings us to the two-stage discounted dividend model, which is perfect for a company like NextEra that's experiencing high growth right now. The two-stage model assumes that the company will grow quickly for the next few years before settling into a more stable growth rate. We'll assume that for the next 5 years, NextEra's dividends will grow at 9% annually. After that, the growth will slow down to a more sustainable 3%. Step 1. Project dividends, years 1 to 5. We calculate the dividends for the next 5 years using the high growth rate of 9%. D1 equals $2.18, D2 equals $2.38, D3 equals $2.59, D4 equals $2.82, and D5 equals $3.08. Step 2. Discount dividends, years 1 to 5. Now we discount each of these dividends to their present value. PVD1 equals $2.04, PVD2 equals $2.08, PVD3 equals $2.11, PVD4 equals $2.15, and PVD5 equals $2.19. Step 3. Calculate terminal value, year 6 onward. At the end of year 5, we assume a 3% growth rate and calculate the terminal value. TV equals D6 divided by R minus G, which equals $3.17 divided by 0.04, giving us $79.25. We discount this terminal value back to its present value. PVTV equals $79.25 divided by 1 plus 0.07 to the power of 5, which equals $56.50. Step 4. Add it all together. Finally, we add everything up to get the total stock value. Stock value equals $2.04 plus $2.08 plus $2.11 plus $2.15 plus $2.19 plus $56.50, which equals $67.07. So based on the two-stage DDM, the fair value of NextEra Energy is about $67 per share. To make life easy for you, I've made a Google Sheet so that you can download it and use this DDM tool to assess any other dividend-paying stocks. Link in description. You might find it helpful to download the Google Sheet and rewatch the video to really grasp the concept. Now that we've calculated the fair value, let's compare it to the current stock price. At the time of recording, NextEra is trading at $65 per share. This suggests that the stock is undervalued based on our analysis. If you believe in NextEra's continued growth in renewable energy and its ability to sustain dividends, this could be a great time to buy. Between its leadership in clean energy and steady dividend growth, NextEra has a lot of upside, making it an attractive option for long-term dividend investors. So, is NextEra Energy the undervalued stock you've been looking for? Based on our calculations, it certainly looks like a strong candidate. As always, make sure to do your own research and consider your financial goals before making any investment decisions. If you enjoyed this breakdown, hit the like button and don't forget to subscribe for more stock analysis and investing tips. Also, do check out my other videos for other powerful tools to evaluate a stock. Links in description below. Thanks for watching, and remember, invest wisely.